we're gonna start. Michael, we're ready to rock and roll here. Okay. Good morning. I'd like to call to order the Board of Commissioners meeting for November 17th and begin as we always do with a moment of silence. Thank you. Please rise for the pledge to the flag. Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Commissioner Kuhn was not able to be with us in person this morning, so he's by way of technology. He's right here. So you go on to public comment.
No, I'm good.
All right. And we will go then to the approval of the minutes of our previous meeting that have been distributed.
Motion to approve the minutes.
Second that.
Okay. We have a motion to approve the November 3rd meeting minutes as presented. Any discussion, corrections, deletions, or changes requested otherwise? If not, all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved. Okay. Now we'll go on to Tina.
Morning, Tina.
Good morning. And just introduce yourself and then we can go on from there.
Tina Tobias, Deputy Treasurer, filling in for Sally today. We started with our cash balance of $3,693,790.28. I said that right.
What was this?
28 cents.
Okay.
Yep. $3,693,790.28.
You got it.
The receipts for the 15th and 16th were $1,034,761.30, which brought our total cash to $4,728,551.58. Less our expenditures of $3,421,605.84, and less tax claims, which was $10,821.51, brings our cash balance to $1,296,124.23.
A motion to approve. Michael,
Motion to approve.
Second.
it's been moved and seconded that we approve the treasurer's report as presented. Any questions for Tina? Not all in favor, please indicate by saying aye. Aye.
Aye.
Opposed, same sign, so moved. Thank you. Morning.
Morning, Michelle Snavely, Director of Human Resources. Under Personnel Transactions, Resignations and Terminations, Megan Snook, full-time telecommunicator in the Department of Emergency Services, resignation effective November 15th. Courtney McMonigal, Assistant District Attorney 1, resignation effective November 28th. Holly Kettering, Office Support 2, Domestic Relations, resignation effective November 12th. Storm Hauser, Office Support 2, Domestic Relations, resignation effective November 15th, with the last working day being October 31st. Hannah McCurdy, Casual Part-Time Correctional Officer, resignation effective November 3rd. Sherry Small, Second Deputy, Monetary's Office, resignation effective November 17th. Michelle Sanger, First Deputy in Monetary's Office, resignation effective November 28th. Judith Adams, Rehab Services Manager in the Renova Center, retirement effective December 17th, with the last working day being December 16th.
I'll make a motion to approve resignations and terminations as presented.
Michael,
Second.
all right, we have a motion and a second on the floor to approve those transactions as presented. Any questions regarding that motion? If not, all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved.
Under leaves of absence, Tasha Ann Cruz, Domestic Relations, 6-month intermittent leave of absence, effective August 31st, returning February 28th, 2023.
I'll make a motion to approve that leave of absence.
Second.
Okay, we have a motion and a second to approve that LOA. Any question for Michelle about that? Not all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved.
Under changes of status, transfers, and promotions, Amber Smith, promotion from caseworker 1 in children and youth to caseworker 2 in children and youth at the rate of $1,319.29 effective December 11th. Patricia Vincent, transfer from administrative assistant 1 in the commissioner's office to probation aide and probation services at the rate of $1,278.46 biweekly effective November 28th. Louise Matthews, promotion from District Justice Office Support 1 in MDJ Dissinger's office to office manager and MDJ Figueroa's office at the rate of $1,208.74 biweekly effective November 28th.
I'll make a motion to approve changes, status, and transfers and promotions as presented.
Second.
Okay, we have a motion and a second on the table. Any questions from Michelle on these transactions? If not, all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved.
Under other transactions, Children and Youth Services would like to hire Susie Lena Mercado as a caseworker 1 at the rate of $1,227.25 biweekly effective November 28th. President Judge Tillwalk would like to hire Patricia Baylor, District Justice Office Support 1 in MDJ Dissinger's office at the rate of $935.20 biweekly effective November 28th. President Judge Tillwalk would like to hire Lisa Clark as Office Support 2 in Domestic Relations at the rate of $1,077.16 biweekly effective November 28th. MHIDEI would like to hire L'Oreales Pagan Mercado as an Office Support 2 at the rate of $1,077.16 biweekly effective November 21st. And the Renova Center would like to rehire Michelle Hefner as a full-time residential services coordinator at the rate of $1,546.40 biweekly effective November 28th.
Make a motion to approve those other transactions.
Second.
It's moved and seconded that we approve those transactions. Any questions regarding the motion? Not all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved.
If there are no questions regarding the transactions presented, is there a motion to adopt these transactions under the salary board?
We don't have one for presented, so moved.
Second, Mike?
Second.
Okay, we have a motion and a second to approve the salary board transactions for today. Any questions or comments? Hearing none, all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved.
And that was Bob Benton in your office, like here. He looked at me, I'm thinking, did you think I meant you?
Probably forgot that was me.
No, I meant Bentley.
All right, thank you, Michelle.
Are you ready to go? Or anyone else come? All right.
Hello,
Great. Yep.
I'm Carrie. Okay. I'm from Mount Gretna. I'm the director of the Mount Gretna Art Show. And I wanted to come today to thank you for your support of the hotel tax grant the past couple of years. Last year, we got a grant. We increased our online ticket sales. And when I did a report for our pre-sale tickets, 85% of those tickets were from outside Lebanon County. So I wanted to thank you for that. We have been named one of the top shows nationwide, the top 200 shows by Sunshine Artist Magazine. It's a professional trade magazine for artists and art shows. And last year we were rated number 38 in contemporary craft, which means traditional and modern craft and handmade production work. So that is a good indicator of future success. For
Can you
the art
remind us
show.
what year this we got then?
Last year it was the 2021 show.
I'm not even know that, but you know, how many years has the art show been?
Oh, well, that was the next thing I was going to say,
Oh, sorry.
because in 2024 the art show is going to celebrate its 50th year.
Okay, well,
50 in 2024.
that's a big deal.
So we are planning some special celebratory events.
Can you get Bruce Johnson and Jeff White to do something nice there?
Absolutely, yeah, we'll be honoring the history and the starting of the show.
We have the 250th anniversary of the country coming. So it's interesting that I think we can do a lot with this, you know, just build it up.
Yeah,
Well, yeah, I don't know how much more success you can handle out there.
Yeah, it's a little crowded.
Another issue. But anyway, thank you for thanking us for our support and the good job you do. Can you just, you have another mission here today.
Yes, we have applied for a grant for the 2023 show. That would be for advertising, billboards, radio and media, and to do national calls for artists.
And that's $5,000.
Oh, that's
It's
10.
$10,000.
Oh, I got the wrong one then.
Yeah, there are two there.
Okay, so you're talking for the Chautauqua Foundation.
It is, yes, it is a joint ask from the Chautauqua Foundation and from to benefit the Mount Granite Art Show.
And I
So
believe
which
she
one
might be
is-
the last 10.
Pardon?
She'll be the last 10.
The last.
What he's referring to is the
10,000.
revised the maximum amount of the grant.
Oh, because we reduced it.
But she already had this one on,
Yeah.
so.
Your application
But-
was in prior.
Now I'm confused. Is the 50 years for the art show or for the Chautauqua?
It's the 50 years for the art show.
Okay, because we switched gears and I wanted to make sure I was on the right. Okay, so I think I got it.
So you're making a motion for
I am making a
5,000.
motion for 10,000.
Good, okay, I didn't know if you were stuck on the 5. or not.
No, I was just trying to get the
Five
right,
years.
the right grant request.
All right.
For $10,000 for the Pennsylvania Chautauqua Foundation in Mount Gretna for advertising to bring in people to visit the area.
It's been my.
I'll second that motion.
Okay, we have a motion and a second to approve a $10,000 grant request. This is kind of right in our sweet spot of 85% coming from outside the county, and that's a beautiful thing for our restaurants and our, hotels, and that's from whence the money comes, so it's all good. So, thank you for giving us the feedback.
Thank you.
Any questions?
Comment.
Yes.
You've also done a terrific job administratively, getting these things to us right on time, whenever they're due to be paid and all that, so. I know when your emails come in, it's ready to go. So, good job.
All right, all in favor of the motion, please indicate by saying aye.
Aye.
Now I'll say aye too, it's unanimous, you have your 10,000 for your program, so thank you.
Is she going to do this one though too?
No, that's not there. That's the Gretna Music. These are two different entities. They just both happen to be in that.
Okay. Very good.
Thank you.
Well, I didn't get attachments to this one.
It's on
All
the
that
back.
stuff she's,
Sorry, I can tell you.
okay,
And that one came to you, I think, in the end of October.
okay. Very good. Now I'm really up to date. Thank you.
Any parting comments? We're good, you finished with, I didn't want to interrupt whatever you were.
I guess all I would say is that I'll keep you informed of what we're going to be doing to celebrate the 50th anniversary. We're already starting committees for some special events, maybe a first book for the community members. And I'm really celebrating the arts in Mount Gretna because it has been such a great vehicle to build community for us.
Yes,
Do you know how many people like attended last year or this past show? Do you have a way of charting that?
About 8,000.
This is the media event.
Oh,
Jim, did you have a question?
Yeah, it's not for her, but I think at the last meeting you talked about the cap being 7,500.
Yes,
Is that across the board, no matter who applies? Is there exceptions like for any group that says it can present facts like this organization that we have met that 85% tier that they might get more than the 7,500? Or is that gonna be-
75 should be what they're looking at. If we see merit that goes beyond that, if we can make exceptions, but we're trying to, lengthen the bank and that the money is in and trying to get more, vehicle out of it. So that's kind of where we are. We're trying to get, preserve the money a little bit.
Spread it around.
But that's the answer for that. 7,500 really should be the last one that got in before that. So we got the 10.
There have been exceptions, but not often. The regulations or the guidelines are theirs. They can waive them if they like. But I remember the last time that.
Might have been Satora.
So it's our one.
Yeah, you
Oh, okay.
fellas were very generous with the Bordner cabin. And that did happen.
Okay.
Thank you.
All right. About that, if you don't mind. Do you want me to go? Yeah, if you don't mind, if you're able.
Yeah. What prep time are you?
Yeah, I figured you were, you know, being a emergency preparedness type
That's
person,
right.
figured you'd be ready.
You're on the spot, all right?
Shouldn't have to ask.
See how it goes. Okay. Good morning.
Good morning.
Introduce yourself. You may proceed.
I'm Bob Dowd, Director of Emergency Services for the county. And I'm here this morning to present 3 grants to commissioners. 1 we're applying for and 2 we're accepting. First is the application for the hazard mitigation grant in the amount of $100,000. This particular grant goes to our required annual hazard mitigation plan update. It's a 4-year update. We're getting ready to process it.
Going to do individually. Yeah. Motion, Michael?
I'll make a motion to approve.
I'll second the motion.
Okay, we have a motion and a second to approve the hazard mitigation plan. And any questions or comments for Bob regarding that? Not all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved.
Okay, next grant I have is the 911 statewide road connectivity grant. This grant specifically funds our regional 911 phone system connectivity that makes it possible. For the next year, it was in the amount of $93,846.01. This is for our network between here and York County for our regional phone system.
I'll make a motion to approve the 911 interconnectivity funding grant in the amount of $93,846.01.
Is there a second?
Second.
It's been moved and seconded that we approve that grant. Any questions or comments? Not all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved.
And the final grant is the annual state Homeland Security Grant Program. This is the grant that funds the South Central Task Force, which is a 9-county task force. The grant is signed by all 9 counties. Dauphin County is a fiduciary agent for the grant, so they manage the money. And all of us have to accept it. That grant is in the amount of $1,209,043.
It's claiming this 100% state grant.
It's all Homeland Security funding passed down to the state.
Make a motion to approve the Homeland Security Grant in the amount of $1,209,043 for the 9-county, I believe it was, regional task force.
Second that.
It's been moved and seconded. Any discussion? Any questions? Hearing none, all in favor, please indicate by saying aye. Aye.
Aye.
Opposed, same sign, so ordered. All right,
Thank you.
thank you.
Thanks for filling in. Sorry, you happen to be here and we're running a little bit, so. All right, we're still running a little bit. So,
He is out there.
yeah, he has a manager. I'm not sure that's here yet, though. So I'll go through a few things I have. That's all right.
Yeah, sure.
First, I have, getting back to the hotel tax, I have a request from the Music at Gretna program asking for a grant of $5,000 for their 2023 summer season for out-of-county marketing. And their total project or annual budget of the program is $425,000. They're asking for $5,000.
So they were the match.
They met the match percentage, yeah.
That's phenomenal.
Less than 25%. Sorry, less than 70%. Good.
I'll make a motion to approve a $5,000 hotel tax grant for, I want to get this right, Music at Gretna, not Gretna Playhouse, it has Music at Gretna.
Michael?
Second that.
Okay, on the floor is a motion second for a $5,000 grant to Gretna Music. Any questions from anyone regarding the motion? If not, all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved.
Okay, next, I have some boards board appointments. The first one being for the Housing Authority. Have a letter from Karen Rao, Director of the Housing Authority, recommending that Leroy Leach be appointed to serve another term. He has been an active member for quite a long time, as far as I can remember. And he is up for reappointment and would serve a term for 2027.
I'll make a motion to approve that reappointment.
Second,
It's been moved and seconded that we approve that appointment. Any questions regarding the motion? Hearing none, all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved.
And next, the Commission for Women has two actions. They've had one member resign due to a change in a new job. And it is Kendra Pugh. Her original term was set to expire February 28th of 2023. But she's vacating that, and they do not have a replacement yet, so there's no action on that. Second part, though, is they had forgotten to include this back in May when they had some other reappointments. Brittany Hilton, whose term ended May 1 of 22, and was reappointed to serve until May 1 of 25. And Maribel Gonzalez, whose term ends 12/31/22, would go to 12/31/25.
I'll make a motion to appoint Brittany Hilton and Maribel Gonzalez to the Commission for Women.
Second.
And my assumption is they'll send a letter to Kendra as a thank you. Okay, we have a motion and a second. Any questions regarding the motion? These volunteers? If not all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved.
Okay, I have 4 applicants for the real estate property tax exemption due to disabled veteran status. They are John Schaefer of West Washington Street, Myerstown, Paul Brennan of Northwood Court, Lebanon, Barry Gartside of Little Pond Lane, Lebanon, and Trevor Webster of Legert's Lane, Anvil.
Entertain a motion, Mike?
Motion to approve.
Second,
It's been moved and seconded that we approve those property tax exemptions for 100% disabled veterans. Any questions regarding the motion? Not all in favor, please indicate by saying aye.
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 Opposed, same sign, so moved.
I have an agreement with for a driver for the Medical Assistance Transportation Program through the Lebanon County Community Action Partnership for Nancy Lebo. And the rates are contained in the contract, same as all others.
I'll make a motion to approve Nancy Lebo as an MATP driver. Medical assistance.
Second.
It's been moved and seconded that we approve that request. Any questions regarding the motion? Hearing none, all in favor, please indicate by saying aye.
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 Opposed, same signs, so moved.
And the last item I have is a renewal of the lease agreement with the Pennsylvania Senate for the district office of Senator Gebhard, which is downstairs by the entrance to the building. They, upon the reelection of Senator Gebhard, they're interested in renewing this lease for another 4 years to December of 2027, December 31st of 2026. And they have increased the rent by cost of living of 8% to $21,518 annually.
Motion to approve.
Second,
We have a motion and a second to approve that office lease at Senator Gebhardt. Any questions regarding the motion? Hearing none, all in favor, please indicate by saying aye.
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 Okay, we have the motion passed. Thank you. What's that?
Question, Bob.
Yes, Mike.
Actually for Janie.
He went out of the
Janie,
room.
on the memo from the Women's Commission, do we need to take action to approve their slate of officers?
No.
No. We appoint the board members and they choose the officers.
I'll take this.
Michael had a question, which Joel answered. Virginia? Anything else, Mike? You feel any better?
That's it.
Awesome.
All that, you want to make sure.
We talked with Karen, and it's the third time I can recall, and I thought maybe third time was a charm. I would really respectfully request that I be appointed to the 250th anniversary committee for the state. And I could work with Karen, and we could maybe tag team, and she could be a backup kind of person. And get if we could approve of the resolution that was provided to us and send that off to the state, I'd really appreciate that consideration, please.
Consider it.
Can I make a motion to execute the resolution today?
I try to. I don't know if we're prepared to do that yet.
I'll make a motion to appoint me for the 250th anniversary committee.
Nice for lack of a second. All right, anything else? I think they're good.
Go on in. Oh,
We went down to meet you and here you are. Come on in, we'll wait for Brett. Brett went down to the door to meet Chris. Chris came in meanwhile. So Brett will be back in a moment, I'm sure.
okay. Just a couple of handouts. Everybody.
I could do the treats.
I wish. Somebody thought that the
Pizza.
security, they thought it was pizza. Wish.
Nugget salad.
Yeah, it's like just that.
Yeah, we'll do it.
Good morning, thank you, sir.
Thank you.
It's phoned in today. He's phoned in.
It's phoned in.
Good try.
Hey, Brett.
Oh, all right. And you got,
I got one from Emily.
okay, one for Sally. And then the rest are. you can go to- Anybody want a copy? This one.
Probably have a sense of the Spencer's. Looks like we are assembled, and I'd like to introduce yourselves and your guests, and then we'll go from there.
Fine. I can go. I'll do it. Okay, that's fine. I just ran up the stairs, so. I apologize.
Are you a
Not as
young
young-
man?
Not as young as I used to be. My name is Brett Holland. I'm with Stifel Financial, and my business partner, Mike Pattistelli, also with Stifel. And we have Mr. Chris Jamison today with Uniplan. He's the president and CEO of Uniplan. And Chris will share obviously a little bit more here in a few minutes, but they're the manager who oversees primarily the REIT portfolio, the real estate investment trust portfolio, which represents a little over $8 million in your portfolio. So with that, we'll get started. Chris is going to speak a little more specifically to the REIT portfolio. We just wanted to just take just a few very brief minutes just to kind of give an update as to where we are for the year so far with the economy and kind of what expectations look a little bit like going forward. The word for this year has been, and everyone in the room knows, it's inflation. That's been the entire conversation surrounding the economy this year. With inflation, the Federal Reserve, which is a division of the government, is trying to counteract inflation. And they basically said that that is their number one goal, is to deal with inflation even more so than necessarily looking after what's going on in the economy. They're willing to sacrifice some growth in the economy in order to bring down inflation. So we've had a total of about 3.75% in the way of interest rate hikes this year. Interest rates have gone up about 3 3/4%. And although that might not sound necessarily like a lot to us here in the room, just to kind of give some perspective, 1994 was considered a very difficult and very aggressive time for raising interest rates. And it was about 2.5% in 1994. So today we're at 3 3/4, and we're anticipating probably another hike in December, possibly. But just to kind of give some perspective of how that affects investments as well, if you look at a 10-year treasury bond, which is considered to be the safest investment in the world. It's considered, they call it a riskless investment. If you bought that in January, back in January 1st of this year, you're down about 15.5%. So more or less your investment has dropped 15.5%. If you go out to a 30-year treasury, just to kind of give an idea with that, which is also considered, again, one of the safest investments in the world, you're off by about a third, about 33%. So these, might seem like small interest rate hikes when you hear it on the news, they have pretty profound effects on what's going on in the investment markets. The economy is slowing, which is what the Federal Reserve is essentially trying to accomplish by trying to bring down inflation. And the biggest area that we're seeing slowing right now is the housing market. Mortgage rates, again, just not to keep throwing numbers around. A year ago, you could get a 30-year mortgage for about 3%. Today, it's about 6.5%. So that kind of slows things down as well. Most of the economists and so on that we would follow at Stifel that we would have confidence in are saying there's a pretty slim chance that we actually avoid some type of a recession in 23. However, most folks are saying as a majority that recession would probably be somewhat brief and somewhat shallow. So we're not anticipating anything extremely disastrous at this point. The three main reasons why that might be somewhat brief and shallow is one is just the balance sheets of U.S. Americans, of U.S. consumers. There's all kinds of numbers. We won't go through that today. People's checking accounts are in better shape today than certainly what they were just a few years ago. And certainly if you go back over the last 15 years, where U.S. consumer, or U.S. taxpayer, I should say, is in a much better spot today than what they were 15 years ago. The second thing is just the unemployment rate. Everyone knows here's about the unemployment rate being around 3.7%. Although we do anticipate that moving up some over the next year, we still feel like that will be at an attractive rate. And then the last thing is just the fact that our banking system, what we talked about when we came in here and met, when Mike and I came in and met back in 2008, our banking system was in a very bad spot at that time, and today the banking system is in a very good spot. So those are a couple reasons why we don't feel like if we do end up going into a slower time in the second half of 23, why we feel like it should not be too terribly bad as what we know today. So that being said, I'm just going to have you go to your report if you would, and we'll kind of go through some specifics in that. Any questions on my comments there?
You know, it sounds like you've spent at least 2 semesters at law school, though, you're answering sort of relevant. Covering all sides of it. That's good. That's very, very good.
Can't tell if the heavy breathing is still from the steps or the nervousness over the numbers.
It was law school, or is it a conference?
So if you go to page 4 of 11, which is the page we always start with there, page 4 of 11 has our numbers. Again, this report is through the end of September 30th. I always say the same thing. Mike will have up-to-date numbers, which are much more attractive than what these are. The quarterly rate of return, if you can see up there in the top left-hand side, we began the quarter, which would have been July 1st, obviously at $126,669,614. We had withdrawals of about 2.7 million. We had a return or a loss of 5.8 million. And then the balance at the end of the quarter was $118,074,120. The column to the right of that, there you can see the column to the right of that. At the beginning of the year, we started at 153 million, had withdrawals just shy of 6 million. And then a loss this past year of about 29 million, and again, the 118 million. Any questions with that at all?
Mike, any questions?
Okay.
No, none from me.
Bottom right-hand corner just kind of shows the allocation breakdown, and just simply showing our cash balance today is about 0%. There's a small portion of cash, but it doesn't register on there because it's such a small percentage. Moving around clockwise, equities are about 63%. Fixed income, or your bond portion, some of that portion I was talking about earlier that's struggling with interest rates, is about 30%. And then alternative investments, which is primarily the REIT portfolio, is about 7% in that. I'll have you go to one more page. If you go to page 6. And, page 6, kind of, this is all the different managers and different accounts that we have listed for the county, and kind of the bottom line there, if you will, on the far left just says total. And we're gonna move across to the 1-year period there is what it is. You see the column of 1, 3, 5, and 10-year period, but the 1-year period, so September of last year through September of this year, the account's down 14.16%. The 3-year number is averaging annually 1.95%. 5-year number is 4.23, and then the 10-year number, which I know is important, is the 5.83% per year. That's what that is. So any questions with that?
I guess my only question, and it's an overall question, not just this page, but after next year, when we come out of the very short recession that you promised, I'm gonna hold you to it. Do you see us recovering and recouping all of our losses, and our pension fund is back up to where it was before?
And that's a fair question, Commissioner. You can't guarantee anything with investments, but
I'm just looking at your expertise with the history.
I heard yes.
historically, things do recover. Yes, I mean, the big thing that we focus on, not just because it's a positive number, but that 10-year number, that it's either a 7 or 10-year number, and the 10-year number is what I believe you defined your obligation for what you all need to put in to the pension. So that's the area where I'd be focusing at. You know, a year ago, we came in here and the numbers were really high. This year they're low. So it all comes down to averages. So to answer your question, I would say over time, I would feel that things would recoup, yes.
Is our assumption 7.15 or earlier on the assumption?
7.25.
7.25.
Yeah, and even that's been great for the last 3 years. We've blown away the assumption. Of course, a drop this steep affects that, but even a slight increase will bring all 3 of those up. So
I really
too worried
appreciate,
about the assumption.
really appreciate your words, because I think it's important to reassure our retired employees that, well, we can't go back and give them COLAs and things like that, that it's important for them to know that their basic payments, because they have a guaranteed payment, which is unusual out there for pension, but it's still secure even though the market is down. They need to hear that once in a while so they don't stress over it. So thank you.
The reality is, if it's down, their payment's still secure because the general fund.
Well, that's what I mean, but if we run out of money, it wouldn't be secure is the point, if it would go down that far. I think that it's going to come
We'd
back
still
up.
owe it.
Yeah.
We'd still owe it.
Of course, we have to borrow it from the bank,
But it's,
but it just makes it more stressful and it costs us more. But they need to know that their money is secure.
You all have done a very commendable job, though, of having funding. I know that's been a big focus in the last 10 years of making sure that the pension is secure, and that's a result of your work, quite frankly. So,
With your guidance.
with that,
okay.
that's my
You're gonna,
Just give you some up-to-date numbers through yesterday's market performance. So through yesterday, we are now down 13.05%. So last couple of months have been better. And so the portfolio has bounced back some, kind of talking about bouncing back. So if you get the right indicators, the right numbers, the market can lift this. So the balance, again, through yesterday, 126,665,330. The net withdrawals, 6,727,387. Net performance numbers, just to put that in perspective, we don't really talk about benchmarks. I think that's a moving target. Our allocations change and so on, so benchmarks tend to be static. But just to put that 13.05% number into perspective, the S&P 500 index for the year is down 15.76%. The NASDAQ, which is a lot of technology and growth stocks, is down 27.4%. Brett mentioned the US bond aggregate index is down 13.17. And then an index that would be comparable to how the pension is set up, roughly a 60-40 allocation, is down 14.72. So on a relative basis, particularly that last index, I think our managers are doing a good job of trying to protect from the downside. And that's kind of how we've always built the portfolio for the pension, is be a little bit more defensive. Even in the really good times, if we don't quite capture all that upside, it's now when the market's down, that we want to be focused on protecting.
I'm sorry, go ahead.
Yep, allocation wise, stocks again are at 61%. The real estate portfolio is at 6%. Allocated bonds are at 27%, and cash is about 6%, just under 6%. So right now we're comfortable with the allocation that we're in. I don't really feel like we need to be making any significant changes, but just a few comments. CS McKee, if you recall back in 2015, I believe it was, actually shortened up the duration or the maturity of their bond portfolio. And that was in anticipation of rates going higher. Okay, in 15 and 18, they did kind of, we tested the markets a little bit, and the rates did go up a little bit. Market didn't receive that too well when that happened. But we've been kind of shorter in our duration in CS McKee. That proved to be probably a pretty good move at that time. As Brett mentioned, with the Treasury notes, the shorter the duration, the less effect it's had. As you go out longer in maturity, those bonds have been down more. Most bond managers now are starting to add duration, starting to get a little longer. If we happen to have a slowdown, as Brett was mentioning, a mild recession, we'll call it, the anticipation would be that the Fed would stop raising rates and potentially even start to cut rates at some point down the road. And if that happens, we want to be longer in duration. So just so you're aware of that, probably in the next 4 weeks, CS McKee will gradually start adding some duration to their bond portfolio. And then I think the other thing that we've been talking about, Brett and I and Sonia, who's not here today, is starting, if we do get somewhat of a rally, and October, November so far have been pretty good. We continue to get some rally. We're probably going to look at raising some more cash for the next 6 months for your distributions. That way, if the market continues to go up, we can let the equities and everything grow. That market happens to dip back down, we don't have to go sell things.
So you want to take that out of the stream.
Correct. So if we get some growth and we can raise some cash, I think that's the right thing to do. In 6 months, hopefully would put us to a point where you're at a point where you're making maybe a contribution into the pension. Usually do that in June or July, right? So just wanted to add those comments. Any questions?
Commissioner Kuhn, any questions for?
No, thank you.
I don't know, Chris, if you're going to talk at all about recession prediction or anything.
Maybe a few comments.
Okay, so before we go to that, just the bond market, if you look at long-term rates, it's a tool to kind of sniff out a recession. So what are you seeing in the long range? Is the bond market indicating a shorter, or is the bond market saying that, the rates are looking like it's gonna be a while?
Yeah, so they look at 50-week moving averages. So the bond market will invert at times, meaning basically that if you buy a shorter term fixed income instrument, it's yielding a higher interest rate than what a little bit of long term. That has been the case, and that's one of the more definitive ways of telling if there's going to be some type of a slowdown. And that's continuing. I'm to be honest, I don't know exactly when that 50-week period is, but I think it's significant enough that that's kind of what's indicating that we're probably going to slow down in the second half of next year.
Anything else? No. Chris, any prognostication along with your?
Paul, on terms of the rates and potential recession, and we're not fixed income managers, of course, we deal with real estate world, but we pay attention to rates because cost of financing is a big important part of that business. As Brett was saying, you've got this inverted yield curve right now where shorter duration instruments yield more than longer duration. That's unusual. It's usually the opposite of that. When you get that inverted yield curve, historically, that means you're looking at a recession 12 to 18 months from the inversion of that yield curve. We inverted earlier this year, about 6-7 months ago. It's held pretty steady over that time frame. So that would pretend that sometime towards the back half of next year, we get a recession. Now, remember, in the first and second quarter of 2022, we had negative GDP growth 2 times in a row. And there was this sort of debate amongst financial prognosticators of, is that a recession or not? I started in this business in 1994. Brett mentioned that was a very difficult bond year where they raised, the Fed raised about 2.5%. At the time, it was one of the worst bond markets in history. I think bonds were down about 5%. So for comparison, bonds are down 15%, 3 times as fast. So I do think that the Fed is absolutely bent on bringing down inflation. And if that means a recession, they're going to continue at it. I drove down the 78 on my way here and, billboards all over the place for employment. They need labor right now. And so when you think about the unemployment rate being below 4%, that means it's a pretty tight labor market historically. And so in order to get that recession, I think the Fed will probably continue to push on rates. The prediction is in December they'll do 50 basis points, and I'm not in the prediction business of that. But unemployment, as low as it is, labor markets as tight as they are, tells me that the Fed still has quite a bit of work to do. Now, the caveat of that is that when the Fed does raise rates, it typically takes at least 6 to 9 months before those rate hikes begin to get felt in the economy. And we're just now at that point from the first rate hikes earlier this year. So there is a risk that the Fed could overdo it if they continue to push on rates, because the rate hike that they just had most recently, again, you may not see that from the effects of it for 6 to 9 months. And there's some academics out there that will tell you that it's more like 18 to 24 months before you really see those economic effects from the higher rate hike. So I think we're probably headed into a recession based upon what the market is, the bond market is telling us. The depths of that recession, I really can't begin to predict. I think it'll be how quickly will the Fed back away? How quickly will they lower interest rates? And I would just echo Brett's comments about the health of the balance sheet of the consumer. I'll talk a little bit about commercial real estate. In fact, just so I don't forget, when you look at the commercial real estate markets today, the REITs, where we manage, and I'll talk about what a REIT is, their debt to equity is about 40% today. Compared to 2008 during the financial crisis, they were about 60% debt to equity. So they had much higher leverage on their balance sheet during the great financial crisis than they do today. In the low interest rate environment that we've had the last 10 years, 12 years, while you've seen corporate America take on debt and they've used that debt to buy stock back, the REITs have done just the opposite. They've paid down debt and they've raised equity, because really that the 2008, 2009 great financial crisis, I think it was a near-death experience for those management teams. It was really questionable at the depths of that market whether or not some of these real estate companies would survive, because they had some 60% debt to equity on their balance sheet. It turned out that none of them went bankrupt. There was one that got in trouble and had to get bailed out because they were north of 75% debt to equity, General Growth Properties, when they were a mall operator. But the health of the balance sheet today for the real estate is much better for corporate America and for the consumer. So I think that will help cushion any sort of slowdown that we I think are going to see. And with that, why don't I just kind of go through the presentation that I was set to give, unless there's any questions about fixed income. So I thought what I do is I just give a brief review of who Uniplan is, what it is we do, how we think about managing a portfolio of commercial real estate through real estate investment trust REITs. I will explain what a REIT is for anybody that may be new here. And then I thought I'd take a look at how we have the portfolio positioned for you today, both from a geographic standpoint and across the sectors of commercial real estate. And then I'd finish with drilling down on 3 of the biggest sectors in commercial real estate, why we're invested there for you. And then I conclude by addressing the question that we all get here, is inflation and how do REITs typically behave in an inflationary environment. So Uniplan, my company, we were started in 1984 by my partner, Richard Imperiali. I was still in high school at that time. But Rick and I have been working together for a little over 20 years now. We're based in Union Grove, Wisconsin, which is about 30 minutes outside of Milwaukee, Wisconsin. Our offices are actually on a working farm. I know you've heard from my colleague, Paul DeJute in the past. Paul retired about 3 years ago, just prior to the pandemic, so his timing was perfect for him. But it's unusual in terms of a setting for a firm that works on Wall Street to be on a farm. We're real estate people. We don't farm, but we lease the land out to some local farmers who rotate some crops every year on the property. We're a boutique manager. We manage a little under $2 billion for institutional clients like yourselves, of which about $1.1 billion is in the REIT strategy. We're essentially 9 investment professionals, portfolio managers, analysts, a couple of support people, some compliance people, and then our traders and line operation folks. I actually make my home in the Pacific Northwest with my family. I don't live in Wisconsin. I grew up in the state of Kansas and moved to the West Coast after college. My dad had transferred companies when I was in college, so I eventually moved my family and my sisters and their families all about that way now. The REIT itself, the real estate investment trust, what we manage for you, it's very similar to other publicly traded companies, Nike, Google, General Electric, what have you. The difference being that in real estate, of course, cash flow is a very key part of the business, right? It's not a terribly complicated business. You kind of know who your tenants are, you know what your vacancy rates are, and you know whether or not your tenants are sending you a check every month. And from there, you pay down your maintenance costs, your taxes, so on and so forth. And that cash that's left over is essentially your profit, the money you make. Well, you always had publicly traded companies, private companies becoming public companies through IPOs, whether they were railroad companies, computer companies, etc., for 100+ years. But what wasn't coming public were institutionally held real estate businesses. And the reason for that was because those owners of those businesses, if they were to come public into the market via a corporation, a C Corp, corporations have what's called, you may have heard of this, double taxation on their dividends. So when a corporation like Nike or Google pays a dividend, the corporation has to pay a tax on that dividend, and then the shareholder pays a tax on that dividend. That's your double taxation. Well, the privately owned institutional real estate companies looked at that structure, at C Corp structure, and said, well, gosh, I don't really want to become public because then I'm going to add an extra layer of tax on my profits after expense cash flow. So Congress and the IRS recognized this limitation for real estate companies, and they created the real estate investment trust structure. And that structure is simply a way for them to come to the public markets, but maintain that single tax structure. The real estate investment trust, when they pay a dividend, they don't get taxed at the company level. Simply the shareholder pays that tax. So that's a much friendlier vehicle for real estate companies than the C Corp. And so that's really the only difference between what a REIT is and what your Nikes and Googles trade for. So if I could ask you to turn the second page, what we're looking at here, I think it's the second page, I'm doing this by memory, is the map. Is that right?
Page 5 is the number.
Oh, excuse me. Yeah. Thank you. So real estate, of course, for our belief is that it's no different than single family housing. At the end of the day, the value of the real estate is often determined by its location. Location, location, location. Central business district office buildings in Tulsa, Oklahoma will be valued very differently than central business district in Manhattan, New York, right? And so we focus our analysis on the local market. What does that local market GDP look like? What does the local market employment situation look like? And what does the local market housing formation look like? Because those three things, GDP growth, employment, and housing formation, are your drivers, your demand drivers for commercial real estate. And so we want to look at markets where we see positives in those three factors. And then we also want to monitor what does the supply look like. Because if you have too much supply, even if you have good demand drivers, you're going to have trouble growing the rents. So we want to make sure that that supply is in check, that we have good demand growth. And where we're finding that, if you look at this map, and I noticed this typo, I apologize when I had this printed up the other day. This is March 31, 2022, not 2021. These numbers were always lagged 6 to 9 months. It just takes a little bit of time to collect the data, but this was from earlier this year. And what this map shows you is 3 different colors, and the states are all colored accordingly. The dark blue means that our portfolio, the one you're invested in, is underweight those areas. If it's the lighter blue, then we're equal weight to our benchmark in those areas. And if it's green, then we're overweight the benchmark to those areas. And as you can see, we're primarily overweight the southeastern part of the United States and the South, if you include Texas. You know, if you looked at, this is actually, it's hard to tell when you look at the Midwest, the Rocky Mountain states, and the upper Midwest, which I'll call kind of Wisconsin, Michigan, Ohio. Those are actually different geographic regions, but all 3 of those regions were equal weighted of right now. If within those regions, though, I could point out, we're really overweight the states of Arizona and Colorado, but because they're in a bigger region, it shows it as equal weight. Looking at this map just prior to the pandemic, we would have been overweight largely the West Coast and the Northeast. But as you had the pandemic, really you had people moving away from the coast because you could work from home, and people that didn't want to have to live where they were and have more affordable housing, get away from higher rent costs. They tended to move largely to the Southeast and the Southwest. Florida certainly benefited, Texas benefited from that, Arizona benefited from that. But this is how we're positioned currently. I don't think this will change much over the next quarter or so. If you turn to page 6, please. This is a pie chart that shows you how we're positioned in the various sectors of commercial real estate. So this includes everything like retail, office, specialty, and I'll talk about that in just a moment. Residential, and when we say residential, that's largely apartments, but there are today some REIT businesses that rent single family housing. That's come about in just the last 10 years since the great financial crisis. Industrial, lodging, of course, is hotels. Diversified, we don't have anything currently in diversified. Diversified would be an operator that does more than one of these areas. A diversified person might do retail and office, so they mix their business. There's not a whole lot of those operators out there. We currently don't know any of them. Cash is just under 3% in the portfolio. It's typically between 2 and 3%. It sort of gives us a cushion for if we see an opportunity, we want to make a transaction, we have that cash available. We don't necessarily have to sell something to raise that cash. I want to talk now just a little bit about the 3 biggest components of the portfolio. Specialty real estate, if you'll turn to page 7 for me. I'll explain what this is. This is in fact the largest part of the portfolio. It's about 36% currently, so just over a third. And when we talk about specialty, although there's a few different areas, really what this consists of are the cell tower REITs and the data center REITs. You also have in there some advertising REITs, what's growing in there are the gaming REITs, the casino operators. In fact, they've been the best performers of the year. They're positive in this market, if you can believe that. But really, the two biggest components here are the cell tower REITs and the data center REITs. And so when you think about the cell tower, the REIT owns the land, they build and maintain the tower, and then they lease space on the tower to the AT&Ts, the Verizons of the world, who of course pay them rent for the space on that tower.
Counties that have 911 equipment on the tower.
Exactly.
We're one of them.
You know that,
We're
you know what I'm
customers.
We talk about this a lot.
Wait,
Are you paying real estate tax? We want to know that.
are we?
Well, the towers.
Oh, the towers, yeah, I mean, it depends, because they may have and this is true with the data centers. They may had a deal with the county or local municipality that they don't pay tax for a certain amount of time to bring that employment to their municipality. So Amazon is somebody that certainly benefits from that right now. They do a lot of their own data centers, and they're not a REIT, of course. But you think about in a recession, probably even though things might slow down, you're probably not going to give up your cell phone, right? And your kids, if you tell them, hey, things are a little slower, we're going to have to, no, it's not going to work. They're going to continue to pay rent. The data center REITs, think of these as your server farms, if you will, right? So the REITs will own the land, they'll build the building. That building has to have very reliable power. Also, because those computers generate a lot of heat, those buildings have to have specialized heating, ventilation, and cooling. So the REITs are big in the data centers. That's the biggest part within the specialty real estate. And I think that will continue, in our eyes, continue to be in demand over the next 3 to 5 years. You're just getting into the front of the rollout of 5G wireless. You're also having more and more things connected to the internet. Parts of your home, lighting, now you can get apps to turn your lights on and off remotely. And I think that will only continue. Your appliances are starting to connect to the internet. They're telling you, we need a maintenance call. And I don't think they can schedule that. I don't have any appliances like that. But certainly specialty. And I'll just mention, if you looked at this prior to the financial crisis, you would have seen retail retail would have been the largest component. It was about 30%. Specialty, the single digit back then, is about 5%. But as retail has shrunk, it's now less than 10% of your portfolio. This is the component that's largely replaced. Switching to page 8, I want to talk about industrial, which is a little less than 15% of the portfolio. We're really talking about warehouses, logistics centers, pass-through centers, if you will. And again, driving down the 78, you can see, there's just warehouses left and right. And they're benefiting, of course, from the growth in e-commerce, online shopping. So as less product gets shipped from the manufacturer to the retail store shelf, it now gets shipped to the warehouse where it sits until Amazon or Walmart, whoever you order it from, comes and picks it up and delivers it to your house. That's partially caused the decline in retail is the growth of online shopping. But interestingly enough, does anybody care to guess, if you looked at all of retail sales, what percentage is online? Anybody brave to take a guess?
50?
50? It feels like it.
It does.
14%
Really?
is currently
Oh.
e-commerce. Now, we used to have a different kind of e-commerce, which was about 9% of retail sales. I know there's some of you that are old enough like me to remember what that was. Do you remember what that kind of online retail was? That was 9% of retail sales. It's catalogs.
I was gonna say Sears, but I didn't really think of it as online.
No, that's why I used quotes. It was, you called them up and on the phone line, right? Made your order. So it feels like 50%, and it's more than 14%. There's only a 5% delta between online and catalog sales of the day. Now that's a 50% change, when you go 9 to 15, 14. But still, it's surprising. I don't think that trend's gonna reverse. I think if you didn't shop online prior to the pandemic, if you weren't comfortable with it, you probably are a lot more comfortable with it now and have used Amazon, probably have Amazon Prime now and those sorts of things. So this business also is benefiting from what we call the onshoring of businesses that have been overseas. Because that's clearly the pandemic showed that there are challenges with supply chains. And so businesses are starting to rethink where they want their components coming from, and particularly Asia is where they're seeing that businesses lead. It won't all come here to the United States, but it'll come to the Americas, Canada, Mexico, and the US will benefit from it as well. Page 9, if you will, the last sector that I'll talk about, this is about 20% of the portfolio. This is apartments or residential, as we call it. Again, single family housing is a business that sprung up over the last 10 years for the REITs. Coming out of the financial crisis, you had just a glut of housing now. There was too much of it. So publicly traded REIT companies stepped in there, started buying them by the thousands. It's been a good business for them. I think it's created some problems for people that are looking for affordable homes. When you look out today, we're at a deficit of about 3.5 million homes at a minimum. We just have not kept up with the supply in building. And when you factor in what rates have done on mortgages, Brett mentioned they've gone from below 3 to over 6.5 now. I've even seen them over 7 in this last month or two. The National Association of Realtors suggests that increase in mortgage rates has now priced about 9 million people in the US out of housing affordability. And of those 9 million, about half of them are millennials. So
Half of them are
millennials,
millennials.
yeah. So there's this demand, this pool of people that just, especially with what's happened with mortgage rates, can't afford to get into housing right now. So that's making the fundamentals for apartments extremely strong. Again, it all goes back to location, but I was just in Arizona about 2 weeks ago, talking to an institutional client, and I looked at the rental rates for apartments in Arizona. And in 2019, you could rent a 2-bedroom, 2-bath apartment in Phoenix for about $1,250 a month. That same 2-bedroom, 2-bath place today is $2,200, just 3 years later. And again, supply and demand. So we want to be in those markets that have not enough supply, have a lot of demand, and hopefully will continue to continue to grow their rental stream.
Before you move out of that, back to your map.
Yeah.
Some of the overweighted area has a lot of coastal exposure, hurricane type exposure. The largest being specialty towers, things like that. But is that a factor when you consider where you invest, or is it simply, these things get damaged, they simply get repaired, and it doesn't affect the lease or whatever they're doing?
So it's really more the latter. Is these are acts of nature, they're going to happen, but there's been times, Hurricane Sandy was an event where we got out of some New York office property because we just said, you know what, the insurance will take care of things, but there's going to be a slow period of occupancy before that recovers. We were able to move out of that particular, they just owned office buildings in New York. So it was a way for us to say, let's reduce exposure there in this particular instance. But generally, it's the latter that you said. It's like, hey, these things are going to happen. There's strong growth in these areas. We want to be there. We can't control what might happen with the weather, and we just have to weather the storm with under.
Okay.
Good question. We see that the same risks, on the West Coast with volcanoes, earthquakes. I live in the Pacific Northwest, so I think about volcanoes. About an hour and a half from Mount St. Helens. So, and then finally on page 10, I just thought I would talk a little bit about historically how real estate and REITs have behaved during inflationary times. So the fine print, if you can't read it, I'll just tell you, you're looking at 3 sets of bar charts here. Low inflation on the left, moderate inflation in the middle, and high inflation on the right. Low inflation is considered below 2.5% inflation. And that's the area that we've been in really since the financial crisis is a low inflationary environment. Moderate inflation is measured as 2.5% to 7% inflation. That's where we were about a year ago, just under 7%. But earlier this year, we flipped to the high inflation, which is over 7.5%. We've been running as high as the 8 zone. We just got a print here, a CPI print that came in recently at just under 8%. But we're still in that high inflation environment. And obviously, we talked about the Fed's going to address that. Historically, when you get inflation in the system, it tends to benefit owners of real estate. And part of the reason for that is because when you get inflation in the input costs that go into putting up a commercial real estate property, steel, concrete, gypsum board, even labor, as the costs of those items go up, it makes the cost to build the structure more expensive. And so if you're a developer of real estate, you're not going to build that more expensive building unless rents have also moved up to compensate you for that higher cost. So in other words, if you're an in-place owner of real estate, you have space to lease, it keeps your competition off the market. If you own a building on a corner and there's vacant land across the street and building costs have gone up 10 or 15%, your competitor is not going to come in and add space unless those rents have also gone up 10 or 15%. So historically, although it's not fun to be in an inflationary environment for the consumer, if you're an owner of real estate, it's beneficial. So let me stop there and see if we don't have further questions or anything I might elaborate on.
Anything for any of our
I guess the only thing that's going through my mind is that it seems, after all these years, really cyclical. And it seems to always come up during a presidential election, that it's the economy, stupid, the inflation and everything. And I'm like, it's gonna happen again. Just listening to you guys, but it's amazing. I don't know, feels weird to know that every so many years we go through that cycle.
Yeah, the business can be cyclical, right? And Mike mentioned that the Fed tried to raise interest rates starting at the end of 2015. That's when your bond manager shortened their duration a little bit. And Janet Yellen was the Fed chair then, and her first rate hike in December of 2015 was 25 basis points. And they just kind of clipped along through 2018 at 25 basis points, just a little bit here and there. And then in the fourth quarter of 2018, the market declined 20% just really quickly, because by that time, Jerome Powell had taken over as Fed. And in about September of 2018, he was asked, like, are you just going to continue to raise rates even though it looks like the economy is slowing? And he made a comment of something like, yeah, the rates are on autopilot right now. We're just going to continue. And the market didn't like that. Market sold off abruptly. And in January of 2019, the Fed pivoted and stopped raising rates and in fact lowered rates. The cycle prior to that, you have to go back to 2004, right? Again, a presidential election year. And the Fed started raising rates in the spring of 2004, and they continued to raise rates through all of 2005 into 2006. So over that 3.5-year period, they raised 17 consecutive times. And when they started, the market didn't like it. The market pulled back. REITs pulled back over 20% in the spring of that year. But one thing that's unlike those other cycles is normally when you go into an environment with higher rates is you got to ask yourself, well, why are rates going higher? And typically it's because of growing GDP, the economy is heating up, which may lead to inflation, or you're getting signs of both of those things. In this environment, I mentioned as I started that we had the first and second quarter of negative GDP prints. We were not getting economic growth. We were getting inflation, which is unusual. And so, again, I'm not in the prediction business. We tend to think about these things a lot, but I still think we're probably, if you look at what the market is telling us, the fixed income market, we're headed towards a recession, but all indications are it won't be a severe long one unless anything foreseen changes. Hopefully that helps.
Yes. Yes, John.
Yeah, I don't know who even addressed this question to, but the 30-year bond you took out last year to pay for the 911 center, does any of the things that are going on today with like inflation and market fluctuations, et cetera, have any impact on that bond issue? And if it does, what are the impacts?
So, me, you want to?
Yeah, no, go ahead.
I don't know, it's you, Jamie, I figure. it might be.
Well, I would say that, no, we locked in
We talked about this.
at a almost perfect time, I think. Our bond rating went to A+. We borrowed in October, November of 2021, which were, I think, historically low rates. And we're locked in. I mean, it's, yeah.
Wait,
And
You guys ordered all the supplies, so we even locked in on the price
Yeah.
of what we need to do.
the bids came in, actually, they came in within a fraction of a percent of the estimates. And the way we structured the bid awards, any inflation to the materials is on the contract, which, it's maybe a little unusual, and they all balked, but if they wanted to be in the game, they had to bid. So
Sounds like a home run.
yeah, we were really happy with the way
We
it
are
went
so
over.
fortunate. It was the right time. And, Jamie and the whole crew that had been guiding this financially for us have done a really good job for Bucking County.
25 years.
Yeah, it's 25.
Okay.
So couldn't predict that we'd be here today, so it wasn't like, oh, should we wait?
Opt-out will tell you that the building will last 50 years, so it'll last twice as long as it costs to pay off.
We were a triple B plus at that point.
Oh, then you got the upgrade.
Yeah, so we could kind of see the edge from where we were standing. And
Yeah, oh
it
yeah.
took several years, but we got up to A+.
Well, even like those REIT managers in 2008, 2009.
Yeah, yeah.
Experience.
It's a little scary.
Okay, anything else? Not, look for a motion to adjourn.
So we're
Thank you all very much.
Thank you all very much. Good information.
That was interesting.
Stand adjourned.
Well, actually, we got about that.